Hey, good morning, everyone. Marty, Missouri here. Tuesday, the 9th of November, 2021. With your morning note, still have the issue with one of my hands that I injured over the weekend. It's nothing too serious, so another day or two I'll be typing away, I suspect. But anyway, in the meantime, just a quick, easy morning commentary for you. Let me just get the markets out of the way first. Stocks are kind of having a rough go of it so far this morning. Dow's down 171 points, which is nearly 0.5%, 0.47. NASDAQ Composite is down 0.80%. S&P 500 is down just over 0.5%, that's 0.53%. The Russell 2000 is down over 1%. It's down 1.02%. Our core portfolio is doing pretty much the same, down a little less than all but the Dow. It's down exactly 0.50%. In terms of what's working in our core portfolio this morning, Latin American stocks are up about 0.5%. Utility stocks are up almost 40 basis points, 0.39%. Treasury inflation protected securities are up 0.25%. Industrials are up 0.12%, and our carbon credits ETF is up 0.11%. The worst performers this morning are MP Materials, which was, I think, our best performer yesterday. It's down 5%. It's going to be very volatile. Uranium miners are down 2.76%. They were up like 6% yesterday. And by the way, folks, we cut that back to our target yesterday. And by the way, we had to cut it by 50%. It was up over 100% since we bought it. There's some interesting dynamics. We like the uranium miner space longer term, given what we know about the energy space right now. There's a company that formed a new ETF that's buying the commodity directly, and they've really done a number on the price to the upside. Ran through the roof a lot faster than I intended, and it seemed to be prudent to go ahead and take some of those profits. So that's been a good position for us, albeit a small position because of its volatility. And we rotated that into our emerging markets fund, which has been an underperformer all year, and it was a little underweight in terms of our target allocation. That's a story that's going to be developing going forward. We have a thesis that's very supportive of emerging markets over the long term. The next worst performers, base metals miners, and then energy services companies, and then AMD, the chip maker, which was a huge gainer for us yesterday. I think when I reported to you in the morning, it was up 3%. I think it closed the day up 11%. Facebook is going to be using lots of AMD chips going forward. So that's your market, kind of your morning market wrap. I'm going to pull over these cuts and pastes. The first from the Fed's financial stability reports, the latest that was issued yesterday. In the kind of their intro, they say that elevated valuation pressures are signaled by asset prices that are high relative to economic fundamentals or historical norms, and are often driven by an increased willingness of investors to take on risk. As such, elevated valuation pressures imply a greater possibility of outsized drops in asset prices. We are hedging against the big bad declines. And then it goes on further, and this is kind of a present conditions part of their report. Across most asset classes, valuation measures are high relative to historical norms. Since the May 2021 Financial Stability Report, equity prices rose further. While this increase is due in part to improved earnings expectations, the ratio of prices to forecasts of corporate earnings stands at the upper end of the historical distribution. That's a fancy way of saying stocks are expensive, historically speaking. U.S. Treasury securities, corporate bonds, and leveraged loans remain at low levels relative to their historic ranges. So the yields remain low, meaning the prices remain high. Supported by low mortgage rates and strong demand, house prices continue to rise at a rapid clip, outstripping increases in rents. Nonetheless, little evidence exists of widespread erosion in mortgage underwriting standards or speculative practices. However, with valuations at high levels, house prices could be particularly sensitive to shocks. Well, of course they can be, and I think they're right. I think the housing market looks far more solid than it did going into the 2007-2008 situation. However, again, prices are very high, and that lends to some confidence. And you'll see that in some recent consumer activities with regard to their equity in their homes. From Bloomberg yesterday, red hot housing market drives biggest home equity drawdown since 2007. Now, think of this in the context of my very first paragraph, and I'll read it again. Elevated valuation pressures are signaled by asset prices that are high relative to economic fundamentals or historical norms and are often driven by increased willingness of investors to take on risk, right? So homeowners are tapping into their property's equity to fund renovation, invest in stocks. Again, what did I just say? Investors' willingness to take on risk and more. The U.S. homeowners withdrew $63 billion in equity from their properties through more than 1.1 million cash-out refinances in the second quarter of the year, the largest quarterly volume since mid-2007, according to data company Black Knight. Just under 1 in 5 American homeowners say they have pulled money out of their properties in the last year, with another 18% saying they are considering it. And then I don't know if you can read this very well, but 42% for home improvement loans, investment opportunities, 27%. So again, when valuations are high and people are exhibiting an increased willingness to take on risk, we've got the greater possibility of outsized drops in asset prices. Couple that with the fact that homeowners' net worth, which is up 31 trillion, as I showed you last week, since last March, more of their net worth is in stocks than have ever been historically. And that's something, make no mistake, that is to be concerned about. Investors can change their minds very quickly as they start losing money. And as I keep saying, that's a concern. And that's a concern for the economy. It's a huge concern for the Federal Reserve when it comes to these asset markets. Now, in terms of today's decline, there seems to be a lot of speculation that it's what I suggested yesterday about Friday, which had to do with Lael Brainerd possibly stealing the job from Jerome Powell, and that's the Fed chair. Stocks love a dovish, easy Fed, but markets don't like change, and the market's done pretty well under Jerome Powell. So folks, I could ramble lots more on lots of other things, and of course there's lots more to come. Let me just update you one more time on markets. Again, don't put too much weight on the short term, but since I do this in the morning note, I'll finish up here. Dow's down 192 points, that's 0.53%. NASDAQ is down 89 points, that's 0.57. S&P is down 0.46%. Russell 2000 is down, it's gotten better, it's down 0.78%. And our core portfolio right now, it's actually come back a little bit as well. It's down 0.43%. So better than stocks across the board, but still down, almost 0.5%. Every time I compare our portfolio to stocks, I feel like I need to reiterate that certainly there's stocks in the portfolio. A tiny bit more non-U.S. versus U.S. And to the extent that we're in the U.S., we're there to take advantage of what we believe are trends going forward and so on. And then the commodities, and then the exceedingly short-term bonds, and so on. So notably different than the overall stock market, I must say. So I'll leave it there for today. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.